The global gross domestic product is approximately $105 trillion, representing the sum of all goods and services produced annually. Yet, the total value of all financial assets, stocks, bonds, derivatives, and currencies, is estimated at over $400 trillion, a leverage factor of 4 to 1 against real economic activity. This is the first contradiction. 90% of all daily transactions on foreign exchange markets are speculative, not related to trade or investment, meaning the price of money is determined by its own movement, not by the flow of physical goods. The second contradiction is systemic. The structure designed to mediate exchange is now primarily a mechanism for wealth extraction from the productive economy into the financial layer. Your labor generates $100 in real value, but the system extracts $4 or $5 of that merely for existing within the credit matrix. You're not paid for your work. You're granted access to a debt certificate. This system operates on mathematical necessity, not political ideology. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. The financial system is not a platform for exchange. It is a machine for arbitrage. To understand this systemic extraction, we need to start earlier. The foundation of the current predicament lies in the shift from money representing an asset, gold or silver, to money representing a liability, credit or debt. This process was formalized in 1971 when U.S. President Nixon unilaterally suspended the dollar's convertibility to gold, effectively ending the Bretton Woods system. Prior to 1971, central banks had an external constraint. For every dollar they issued, they were, in theory, liable to redeem it for a specific weight of gold. This external anchor limited credit creation and forced a correlation between real production and monetary expansion. This was the real shift. The move to a pure fiat system meant that money was created through debt. When a commercial bank grants a loan, a mortgage, a business loan, or a credit card line, it does not transfer existing funds. It creates new funds. The loan is an asset for the bank and a liability for the borrower. The total supply of money in the economy is therefore directly proportional to the total amount of debt created. Since the 1980s, the speed and complexity of this debt creation have accelerated exponentially, far outstripping the growth rate of the underlying industrial and productive economy. In 1950, U.S. total debt, government, corporate, and household, was approximately $2 trillion. Today, it stands at over $90 trillion. This system guarantees that the productive sector must always work harder to service the financial sector. The money that services the interest on the debt, the interest payments, must come from new production, new profits, or more new debt. This is the core engine of the system designed to keep the majority perpetually in motion. The average household must dedicate a fixed percentage of its monthly income to service non-productive debt like mortgages and consumer credit. This is capital flowing from the bottom of the economic pyramid, labor and small business, to the apex, the financial institutions that hold the original debt instrument. The introduction of fractional reserve banking historically amplified this. Banks are required to hold only a fraction of deposits and can lend out the rest, creating a multiplier effect on the original deposit. While this specific reserve requirement has been manipulated or eliminated in modern central banking, the principle persists. Every unit of base money can support several units of credit money. This mechanism ensures that the financial system is structurally larger than the real economy it purports to serve. Confidence became currency. The numbers told a different story. In the post-1971 era, the growth of financial assets has consistently been 3 to 5 times faster than GDP growth. This divergence creates an asset class that is unaffordable for the productive class. Consider the housing market. The cost of a house is largely a function of the interest rate structure and the availability of credit, not solely the cost of building materials and labor. When the Federal Reserve drops interest rates, it makes the monthly mortgage payment lower for a fixed principal, which capitalizes the interest rate drop into the asset price. The lower rate allows the borrower to afford a higher nominal principal. The result is that housing prices climb, making the initial hurdle of homeownership, the down payment, higher, while the bank collects a higher total interest over the life of the loan. The financial system absorbs the benefit of the lower interest rate, not the productive economy. The borrower is granted access to the asset only by agreeing to a higher total lifetime interest payment. This is not a housing market. It is a credit market disguised as a housing market. This perpetual financialization of tangible assets is the structural mechanism that ensures wealth is concentrated at the center of the credit matrix. The institutionalization of this process accelerated with securitization in the 1980s and 1990s. Mortgages, auto loans, and credit card receivables were bundled together and sold as bonds, asset-backed securities. This moved the liability from the bank's balance sheet to the global market, allowing the originating bank to immediately turn around and issue more loans. The risk was dispersed, but the underlying debt engine was accelerated. This mechanism created infinite capacity for debt creation, ensuring the flow of principal and interest continued to feed the financial apex. The battlefield became the balance sheet. The continuous expansion of credit is necessary to prevent the system from collapsing on its own interest demands. If credit creation stops, the flow of money necessary to service the outstanding debt is interrupted, leading to mass defaults and systemic failure. Therefore, the system is structurally compelled to expand regardless of economic necessity. The transition into modern mechanics reveals a system that is colder, sharper, and fundamentally self-referential. The primary mechanism keeping you poor is the mandatory velocity of money required by the debt-based system, often termed the interest-principal dynamic. The total outstanding debt in the U.S. alone requires annual interest servicing in the trillions of dollars. This servicing cost is a constant draw on the productive economy, creating a drag that must be perpetually offset by productivity gains or new borrowing. This dynamic is exacerbated by the institutional incentives embedded in the central bank structure. The Federal Reserve, by managing the short-term interest rate, dictates the cost of credit for the entire economy. A sustained period of near-zero interest rates after the 2008 crisis, a key example of modern policy, created massive power asymmetries. This zero-rate environment did not primarily benefit the average saver or small business. It overwhelmingly subsidized the largest borrowers, sovereign governments and massive corporations. They refinanced their existing debt at record low costs, hoarding liquidity and using the cheap debt not for productive investment, but for financial engineering, primarily stock buybacks. Stock buybacks, where a company uses cheap debt to purchase its own shares, artificially boost earnings per share, EPS, enriching executives and existing shareholders. From 2010 to 2020, C&P 500 companies spent approximately $5.3 trillion on buybacks. This is a direct financial flow from the credit creation machine to the shareholder class, bypassing the labor market entirely. This is rollover risk, applied to the corporate balance sheet, where solvency is prioritized over investment, ensuring that the returns from credit expansion accrue to the financial layer, not the productive one. The average worker is trapped in this cycle through asset inflation without wage inflation. The central bank's liquidity injections cause asset prices, stocks, real estate, fine art, to rise, creating a wealth effect for those who already own assets. However, because the money does not flow into industrial capacity or labor-intensive hiring, wages remain stagnant. In the U.S. from 1979 to 2020, productivity increased by over $60 per centile, but average hourly compensation for production and non-supervisory workers grew by only $17 per centile. This structural divergence means the productive class is constantly falling behind the inflated cost of living engineered by the credit system. The illusion holds until it doesn't. Furthermore, the system creates mandatory more liquidity dependencies at the state level. Consider the Eurozone. Countries like Italy face continuous rollover risk on their national debt. They rely on the European Central Bank, ECB, acting as a quasi-backstop. The ECB's actions, such as the outright monetary transactions, OMT program, are essentially conditional promises of liquidity. This subjects the indebted state to non-elected institutional control from Brussels and Frankfurt. Markets enforce what politics avoids. The state cedes fiscal sovereignty to maintain market access. This mechanism of control is duplicated domestically through regulatory capture, where large financial institutions dictate the terms of their own supervision, ensuring they maintain preferential access to cheap central bank funding. The derivative market epitomizes this self-referential design. The nominal value of outstanding derivatives, contracts based on the fluctuation of underlying assets like interest rates, currencies, or stocks, is estimated to be in the hundreds of trillions, many multiples of global GDP. These are financial products that create risk on top of risk, providing liquidity and yield to the largest institutions, but offering zero productive benefit to the real economy. It is a mathematical casino that determines the cost of capital for everyone else. What cannot be repaid will be rolled over. The scale of this financial layer means that any correction in this $400 trillion matrix will crash the $105 trillion real economy. The system is designed to prioritize the solvency of the financial architecture over the prosperity of the productive base. The exit is mathematically sealed. The final stage of this system's operation centers on the capture of individual financial autonomy through structured financial products and the psychology of continuous debt. This is the implementation of credit velocity as a mandatory lifestyle. The average person is not only an economic actor, but a debt instrument. The financial system profits not only from the interest on outstanding debt, but from the transactional fees, the late penalties, and the structured incentives that encourage perpetual leverage. The student loan mechanism in the US is a perfect illustration. Unlike almost any other debt, student loans are non-dischargeable in bankruptcy. This legal framework provides an almost risk-free asset for lenders, who can issue loans knowing they will be repaid regardless of the borrower's future economic performance. The total U.S. student loan debt exceeds $1.7 trillion. This debt is front-loaded onto young workers, limiting their capacity for capital formation, down payments, business investment for decades. This is an efficient, targeted mechanism to suppress the accumulation of generational wealth outside of the established financial system. The young borrower is structurally poor from the moment they enter the labor market. The mechanism of credit scoring, FICO, further enforces this. A high credit score, which is necessary to access low-cost credit for major purchases, is not achieved by being debt-free. It is achieved by managing a sufficient quantity of debt responsibly. You are rewarded for being a reliable, perpetual debtor. The system mandates participation in the credit matrix. Choosing to operate outside the system by using cash exclusively and avoiding credit instruments is financially penalized by denying access to optimal borrowing rates. Confidence decides who survives. The individual is forced to adopt the logic of the financial system to survive within the marketplace it created. Furthermore, the proliferation of private equity and asset managers, such as BlackRock and Vanguard, concentrates ownership of nearly every major public company. This means that even investments made through retirement accounts, the average worker's primary attempt at capital accumulation, are filtered through the same financial institutions that benefit from the overall debt structure. Your 401 killer is invested in the companies that execute the stock buybacks, which were funded by the cheap debt, which was subsidized by the central bank. The returns are generated not by productive output, but by the financial engineering of the corporate balance sheet. The ultimate structural barrier is the concept of Meyer's monetary policy asymmetry. The financial system is designed to transmit liquidity quickly and efficiently to the apex, the major banks and investment firms. When a crisis hits, the central bank immediately injects trillions into the financial system to prevent a systemic collapse. However, the transmission mechanism for that liquidity to reach the bottom, small businesses and individual consumers, is slow, inefficient, and often requires taking on more debt. The system is hypersensitive to financial failure, but systematically resistant to individual prosperity. The only true beneficiaries of a financial crisis response are the institutions deemed too big to fail. This perpetual bailout mechanism externalizes the risk of the financial elite onto the productive tax base. It is the final devastating piece of the architecture. The money is made on the difference between the risk you bear and the returns they take. The financial system is a highly efficient machine for transferring wealth from the future productive capacity to the current holders of financial claims. You cannot escape its mathematical mandate. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.